Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. A common theme of reporting season this year was a return to higher dividends, leaving plenty of investors happy. Now, a new report reveals just how strong Australia's dividend rebound has been. According to Janus Henderson, dividends from Australian companies are growing 4 times faster than the rest of the world. Janus Henderson is a global asset manager with around $580 billion in assets under management. Jane Shoemake is a client portfolio manager of global equity income at Janus Henderson, and she joins me this morning from London. Jane, welcome to Fear and Greed.
Morning.
Why is Australia so good at dividends? 4 times, that's a massive leap up on other jurisdictions.
It's really brilliant, isn't it, to see dividends being so strong in Australia, but we have to put that in some context. Last year, when we had the pandemic, Australia was one of the worst countries in the world for dividend cuts, and it saw a very sharp fall in the dividends that were being paid, over 40%. So there were a couple of countries like Australia, that was the UK, France was in there as well, where dividends were really just decimated because of the pandemic. So what we're seeing this year, and very encouragingly, is a very strong bounce back from that very sharp fall.
Okay, if we just take a step back, Australia generally is a relatively high dividend paying country. That's a question.
Yes, it is. It's a high-yielding country, again, up there with the UK. And I think in particular what happened is you saw those high-yielding countries having to cut their dividends a lot. In particular, the banks were restricted from some of their payments, and they're an important part of the Australian market. And then other parts, consumer discretionary, that obviously some of the retailers, the travel and leisure, they had to cut their dividends drastically or not pay them at all.
Yeah.
And so really what we saw was a resetting of dividend expectations. And I think also that Australia had a very high payout ratio. It paid out a lot in dividends. The pandemic has given the companies an opportunity to sort of reset that level.
Okay. So as we go forward, I mean, with the bounce back, what sectors particularly have come back hard in terms of dividends and paying well?
So this year we have seen extraordinary results from the mining companies. They posted record profits, and that then fed through to not just regular dividend payments, but also some special dividends. So BHP, Rio, amongst others, paid a lot more out in dividends than anyone had anticipated. And that's really on the back of the booming commodity price market. Australia clearly is very exposed to the mining sector, and so that has massively helped with this rebound. And then the banks were the other one, where we've seen dividends being reinstated as regulatory restrictions were eased. So banks and miners have been an absolute key driver with that bounce back for Australian dividends this year.
But very possibly it could actually be a one-off, is that right? Because particularly in the mining sector where you had these ridiculously high commodity prices, particularly iron ore in BHP, Rio and Fortescue Metals case, and therefore hence the special divs.
Yeah, I mean, it's interesting, isn't it? Iron ore is one of the commodities that's actually fallen quite sharply in recent months. And so clearly that's not going to be such a positive for next year. So a lot of the mining companies now have a fixed payout ratio. That means they'll distribute a certain amount of their profits in dividends, and that's fixed. And therefore, if their profits fall, their dividends will fall.
Yeah.
So I do think it's highly unlikely that we're going to see the same level of growth next year in miners as we have seen this year. So it's very hard to forecast what commodity prices are going to do, but I do think that will be a headwind going into 2022, just because it's been such a huge peak this year.
Okay, so when you're investing, and for people like me who don't have the experience or knowledge that you do, I mean, how many people do invest on that income, on the yield? Is it a big part of the market?
Clearly, there's some investors where yield is very important, income is important, and particularly for retirees, for pensioners, they want that guaranteed income. And therefore, I think it's really very important to be diversified. And one of the problems with the Australian market, if you only invest there, is it is very concentrated.
Yeah.
So the miners and the banks are going to make up about 80% of all the income paid in the Australian market.
Really?
And that's incredibly concentrated. So what we would argue is, yes, have some exposure to domestic Australian equities, but also have some diversification by going global and getting access to some of those other dynamics. Because clearly, if the banks or the miners are hit again, your income very much gets impacted.
Okay, so I want to come to international options in a moment. You said that the resources have a fixed payout ratio, so a fixed amount of earnings. Is that normal? Are the banks the same? Are the other dividend stocks in Australia, the telcos and things like that, are they the same, or do they mostly float a bit?
The miners didn't used to have a fixed one. They used to try and constantly grow their dividends, but that put them under a lot of stress when clearly commodity prices fell very sharply and they were desperately trying to pay out a level of dividends. So they've just taken that pressure away from them. Other companies tend to try and pay a dividend, sustain it, and then grow it. But those will be with businesses that are less cyclical and therefore don't get these sort of very sharp variations in profitability that the miners can experience.
Okay, so where do the banks fit into that? Because it's funny, banks seem to be becoming more cyclical than I used to think of them.
I think the banks, to be fair, in Australia have always paid out a very high dividend, and that was a very high payout ratio, and they were known for that. Then clearly what we had in the pandemic, which is not what we've had in previous crises, is we've had regulatory intervention, where the regulators come in and said, look, we're really quite concerned about what's happening with this pandemic, and clearly none of us knew what the outlook was going to be. So we want you to be very, very conservative and really think about how much you pay out to shareholders. And I think what's happened then for the banks in Australia is that allowed them as well to just reset that dividend. I would argue they were paying out too much in dividends, actually, and they needed to bolster their capital positions and pay out less. And so I think now what we're going to have is a little bit more of a sustainable level of banking dividends in Australia. Having said that, they've come back this year and they're only going to be about 15% lower than their pre-pandemic levels. So they weren't paying out as much as they were, but it's not that far off. It's just, as I said, around 15% lower.
Stay with me, Jane. We'll be back in a minute. My guest today is Jane Shoemake, Client Portfolio Manager of Global Equity Income at Janus Henderson. Okay, so you were talking about diversification a moment ago. If I am looking for income, looking for a dividend regularly, and I've decided that I'm too concentrated if I stick with the Australian market because of resources and banks, as you mentioned, what countries should I be looking towards if I'm looking for dividend yields?
It's interesting because I think you have to look very specifically at individual companies. And so in the US, for example, the market in aggregate doesn't pay out a huge dividend at all, and actually share buybacks in the US are quite a lot more popular. Having said that, within the US there are still stocks that yield 3, 4, 5%, and so it does come down to being very stock specific. For example, as well in the US, you've got exposure to the tech sector. Now, people think that tech companies don't pay dividends, but actually some of these companies now are 30, 40 years old. They've matured quite a lot, and they do pay out some quite attractive dividends in the tech sector, plus they grow them very nicely. There's a lot of cash flow being thrown off by the tech sector. So there's a whole sector in the US that you just can't get access to in Australia. There's just not the exposure, there's not the companies there. So some really interesting dynamics, but I do think it's quite individual and quite stock specific.
Okay, and of course there are tax implications too, because the Australian system benefits dividend payouts received from local companies as opposed to offshore.
It absolutely does. You've got franking credits in Australia, which does make your domestic market more attractive from a tax perspective. And so absolutely, everyone understands that if you're in Australia, it's beneficial to invest in your domestic market. But all we're saying is have some exposure, but just be aware that it's in a very concentrated number of stocks. You're very reliant on just a small number of companies for some of that income, and that it's a really good idea to have a proportion of your assets in a more diversified portfolio, albeit you're not going to have that tax benefit that you get from the franking credits.
Okay, if you're advising investors, obviously we're talking about dividends here, but there's a real reason to focus will be on dividends into growth stocks, that type of thing.
What we do actually on our desk is we look for that yield. So we'll look for companies that yield typically between 2 to 6% globally. But really importantly, what we're also looking for is a bit of that dividend growth. So what we want is to see a sustainable dividend, but also companies that are investing, that have the ability to grow their dividend. Because if you get some growth, you usually get capital growth as well. So the balance between some yield and some of that growth element as well. And what you can see is actually over the long term, dividends grow globally by around 5 to 6% per annum. Now, when you're in a high inflation or an inflationary environment, that little bit of growth there in that dividend is a really very much a hedge against some of that inflation you're going to experience. So we think it's just getting that balance right between the yield and the growth.
Okay. Is there a rule of thumb in terms of what the average dividend is in Australia or globally?
No, not at all. I mean, you obviously can look in aggregate. So, the UK, Australian markets are yielding 3-4%, and then you've got Japan and the US yielding below sort of 2 generally. But no, there's a whole range of different companies yielding different amounts.
Yeah.
And what you have to do is just analyze them on their own understanding of their businesses, what they're paying out. Also, really, we don't want people to pay dividends at any expense. What we need is sustainable businesses, and therefore they must be investing as well. So it's really about the companies and the management making sure that they invest in their businesses, they're growing them, but they're also generating enough cash flow to pay us a dividend.
Jane, thank you for talking to Fear and Greed.
Thanks so much.
That was Jane Shoemake, Client Portfolio Manager of Global Equity Income at Janus Henderson. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.